Trump and Ukraine's President Zelenskyy, of course, met in the White House and actually clashed in the White House. That's basically the way to put it. So there was, those visuals you would have seen, a full day of sort of meetings, etc. Then there was a press conference which was scheduled, and that press conference was just a briefing before that minerals deal was supposed to be signed, where U.S. gets access to develop Ukrainian mineral and oil and gas assets, etc., in exchange for mediating a peace between Ukraine and Russia. And it was just supposed to be, things looked like, if you watch the full 50 minutes, things were actually going pretty well, except the last 10 minutes or so, and specifically the last 7 minutes when it really all kind of went up in smoke, and there were arguments in front of TV cameras. And then Mr. Zelenskyy was actually asked to leave the White House. It was a complete disaster, which really played out in that sense. What does this now mean? Of course, in terms of just watching this, it kind of opens the doors in terms of what happens behind the doors, because you don't see this very often. I don't think we've seen this at all. So raised voices, tension, etc. But what does this now actually mean for the peace process? Because markets have been, at least, some markets have been pricing in a peace deal, which was imminent. Does that get pushed out now? Ed Yardeni is president at Yardeni Research. Ed, good morning. Good to have you with us here. Thank you for waiting. What does this mean, Ed, according to you?
Well, I think we've already seen one obvious reaction to what's going on, and that is defense stocks have been very strong in Europe. I think there's a growing sense that the whole NATO structure is being questioned. The commitment to the United States to defend Europe is being questioned, and certainly the commitment to the United States to defend and help Ukraine is certainly being questioned. But you put it all together, and it's going to force the Europeans to get their act together, which could be a positive. As you know, the stock market there is doing extremely well. It's partly because it's cheap, and maybe it's partly because they are going to have to respond to this changed geopolitical situation, the new world order that seems to be emerging by becoming stronger, more united, and having more of a direct policy. So I think that's actually turns out to be a positive for the global economy. It might actually allow the United States to cut back a little bit on defense spending, simply because the Europeans will be picking up more of their own spending. But I think for the stock market in the United States, as we saw when the acrimony, when the dispute was going on in the White House, the stock market sold off, but then it had a nice rally at the end of the day. I think at the end of the day, what really matters here is the economy, and there's been some concerns that the economy is weakening. I think a lot of that had to do with weather. January was the coldest month we've had, a January month that we've had since 1988. And so I'm expecting to see a pretty nice rebound here in retail sales, employment. And so I think a lot of this concerns about a soft landing, a soft patch, a recession, I think that'll evaporate just the way it did during the summer of 2023.
That's interesting, Mr. Yardeni, and you've been maintaining a positive stance on the U.S. economy and the U.S. stock market for a while, and you've got it right all along. So you're saying that this is just maybe a transitory phase. So not too concerned about those numbers like, the consumer spending number, retail sales. There was this Atlanta, Fed GDP tracker, which is predicting, a drop in GDP in the first quarter. So you don't see this as being a concern. What about tariffs? When people are getting worried about what it does to inflation, and if that's a reason for the market to take some profit off?
Well, what just happened with the estimate for real GDP is very much related to the question that you just asked about tariffs. Clearly, a lot of importers decided to get moving faster and to bring goods into the United States before the tariffs are slapped on them. So we had this huge increase to a record high in imports. And when we calculate real GDP, we subtract imports from that number. And so it was sort of this anticipation of tariffs that led to a huge increase in imports. At the same time, consumers didn't really spend much. Actually, consumer spending went down in January because of the bad weather. So it all added up to a sharp fall in real GDP. I think a lot of that's going to be reversed. I think the first quarter is still going to come in positive for real GDP at 1.5% to 2%. With regards to the tariffs, this is the art of the deal to remind us of the book that Trump wrote and kind of what he views as his modus operandi, how he gets things done. What's unusual, as you folks said, is that it's so public, and it was pretty ugly to watch on Friday. But it is deal making. It's not a pretty sight, and I think at the end of the day, we're going to find that there's going to be a lot of negotiations that actually lead to lower tariffs. I think that's really the point of all these reciprocal tariffs that the United States is imposing, is say we're just not happy with the current trade situation, and we need to have it improved. So I think this all ends well. I don't think it ends badly.
Okay, all right. Then what would that mean for the stock market, Ed? You were calling for a couple of months ago that the U.S. markets could cool off a little bit. That's happened to some extent. Yeah. Where do you see the U.S. markets headed from here on? And what about the Indian markets? Yeah. We've been under the weather, for the last few months. Post this correction, and since the economy appears to be improving on ground, what's your view on the Indian markets?
Well, with regards to the U.S. stock market, I did think we were going to have a cooling off, a pullback, maybe even a correction in January. January turned out to actually be a strong month, but I think we're experiencing that choppiness right now. We haven't made a new high. Well, actually, we made a new high February 19th, not too long ago, but it's really been kind of choppy at this kind of record high level for a few months. And I think it remains choppy until we get through the fiscal deficit budget negotiations that are coming up here in mid-March. And then I think the market goes up on better than expected economic growth, better than expected earnings. And I still am using 7,000 as my target by the end of this year for the S&P 500. With regards to the Indian market, I think what we're seeing is that global investors decided that they had too much in the Indian market. The valuation multiples got stretched, and they saw an opportunity to rebalance their portfolios more into China, more into Europe, and those stock markets have done well. And now I think it's back to the fundamentals. And as you said, the fundamentals for India still look pretty good. The stocks are cheaper now. And so I think we're going to find a bottom here. But we may have some consolidation for a while before we resume the climb towards the previous record high. So I think it's kind of the same story for India and the United States stock markets. A great performance, some need for profit-taking consolidation. The underlying fundamentals are still quite good. Global investors will diversify back into India and into the United States.
Okay. All right, Mr. Yardeni, we will leave it on that note for this morning. Thanks very much for joining in. That's good to hear. I think the market participants in India will even take consolidation with both hands as long as the fall stops.